Today we will talk about indexes and index funds, how it works, how does it affect the stock price, and are index funds a good investment for you? I would also like to clarify some misunderstandings about indexes. Now let's go. Oh wait, you thought I would forget about asking you to click the like button and subscribe to my channel. With this, you help the YouTube algorithm to spread our video and help other investors as well in their investing journey. Now let's go. First of all, I would like to remind you guys I'm not a financial advisor or anything, so this is all for educational purposes only. Most of you have probably heard of the index rebalancing, right? Anyway, before we tackle onto that, what is an index anyway? So there are many kinds of indexes. Some are concentrated to follow the largest companies in the economy, while some concentrate on emerging markets. To give an example of this index, we have our very own PSEI, which follows the 30 largest company based on market capitalization in the Philippines. Now, just a quick lesson. Market cap is computed by total number of outstanding shares multiplied by the price of the stock. Now, I told you this because most index weighs their components by market cap. So if that company has a very large market cap, it has more weight or percentage in the index. For example, we have two companies. Company A has a 900 billion market capital and the company B has a 100 billion market capital. So in the index, company A has more weight or percentage than company B. Indexes doesn't have a balanced allocation. Company A may have a 10% allocation while company B has only 2%. Now we can go on to the rebalancing part with this understanding. Example, if an index only has 30 components like the PSEI and one of their components' market cap falls down, it can either be removed and be replaced by another company that has a much larger market capital. Or if it wasn't removed, its weight in the index can either be switched to one of the component that has now a much larger market capital than the other one. Like what I exampled a while ago, stocks in an index don't have equal percentage or weight. So when a component stock price goes down, since price is connected to market capital, its percentage in the index may be lowered. This is how most index works or rebalance their stock. With this, we go to the misconception about index rebalancing. Indexes rebalances their stocks without looking at the company's fundamentals, like its financials, products, and competitive advantage. All of those things which are in our checklist, they don't look at that. Most indexes rebalance their components automatically based on market capital. This is a common misunderstanding. Some companies was removed from an index, but that company's fundamentals didn't change. Its financials didn't change. Its governance didn't change. It just looked at the price of the company. A lot of things makes a stock price fluctuate leading to this. It can be driven by news or issues. So even if the company's fundamentals stay the same, some stocks price fall because of this certain issues or news. These things really happen in the market, it's crazy. But of course, that's your job as an investor to look why the company's price fell down in the first place. It's the same for the PSE index. Its components are weighted by market capital, not by fundamentals of the company. So don't just invest blindly because of an index rebalancing or whatsoever. It doesn't mean that it's one of the components of an index. The fundamentals of the company is great. So with that, we go on to our next question. Why does being in an index a big deal? Well, indexes have a great role in increasing the price of a company. Again, the price, okay, not increasing its fundamentals. Let's use PSEI as an example again. A lot of funds imitates the PSEI. Now these are called an index fund. This can either be through an ETF or a mutual fund. So for those who hasn't watched yet my video about this, I explained there the difference of an ETF and a mutual fund. There's a link above if you want to watch it. Going back, these funds copies all the companies listed in the PSEI, their weight, percentage, and all. So they just invest in those companies because it's automated. It just copies it. Now this can drive the stock price to go up. Likewise, if a company is removed in the PSEI, since these funds copies or tracks the PSEI, they are also obliged to remove that company in their fund, selling that stock, driving the price of the stock lower. So how does this affect us as investors? Well, if you are a long-term investor, this can be a buying opportunity for you. Of course, it's after you've done your research about that company. You can say to yourself, wait, this company's financials and competitive advantage is great, and its stock price is dropping. This is a great opportunity for me to buy more of this great business at a much cheaper price. But if you are a short-term investor, this can be a negative thing on your part because the stock price will definitely go down, not allowing you to sell your position at a gain. Well, exemption if you are short on that stock. So for us investors, you really have to take note on the dates where indexes rebalances, like the recent news in the MSCI index, because these news can be a great buying opportunity for you. But still, if you're in it for the long run, it doesn't much affect you whatsoever, especially if you've done your part well to study about the company. Now we go on to our next question. Are index funds a great investment for you? Now, index funds are a great choice if you don't want to research individual stocks. Index funds is more or less the representation of the economy's growth. It's like investing on the whole country itself. Now, even the world's greatest investor, Warren Buffett, advises the mass to just invest in an index fund. Although index fund lags behind only a tiny bit compared to the real returns of the index because index funds have some fees. Still, it's just a tiny bit. It's still a good investment for people that doesn't want to invest on individual stocks. But again, I see some people say, oh, their investment isn't growing, but I invest in an index fund. I thought this is a great investment. Of course, if you only look at the short-term gains, then you will feel that way. The stock market has cycles in it. That's why index fund investing is a long-term investment. You are in it for the long run. Don't just look at 1 year to 5-year performance. No, your horizon should be at least 10 years or more. For example, you started investing in an index fund that tracks the PSEI in 2016 to 2018. For example, FMETF. Of course, I'm sure you are in the negative right now because the stock market dropped. And that was, I think, the highest moment of the index, which is 2016 and 2018. Again, the stock market has cycles in it. It's not a constant uptrend. That's why it is advised to cost average your way when investing in an index fund. Don't just dump your money one time big time and assume you will gain 8% instantly the next year. No, you have to invest regularly. This is not a sure 8% yearly gains, guys. Some years you are negative and some years you have a positive growth. The 8 to 10% return they say is average returns. That means in the lifespan of the index, starting from day 0, it returned an average 8 to 10%. It's not yearly returns. It's average, guys. Well, if you are the lucky guy who invested in exactly in March of 2020 in an index fund, then lucky you. Your portfolio right now is, I think, more than 20% gain, if not 30% gain in just 1 year. But even though you invested at the wrong time, but still cost average your way, as years pass by, it's been proven that stock market gains an average 8 to 10%. Just to show you proof, I have made a video about market crashes in the Philippines. So just click on the link above if you want to watch it. Again, the greatest investor, Warren Buffett, suggested index funds. Most fund manager can't even match up to an index fund's return. And an index fund has a much lower fees compared to an actively managed fund. But still, even if you are going for index fund investing, you still have to research or study it first. Because if you don't, then you will always be surprised when it drops. Always prepare yourself when entering any form of investment. Let's go to the smart side, not just in the speculation side. Now I think that's it for this video. Again, if you have any question about indexes or index fund, do comment down below, guys. I would really love to hear from you guys. So thank you, happy investing, and see you in my next videos.